Welcome to the Deep Dive. This is Talk Tickers, bringing you the essential summary from the earnings calls.
That's us.
Today, we're digging into Gilat Satellite Networks' first quarter 2025 results. The call was on May 19th, 2025.
Right. And overall, if you look at what they presented, the tone felt, well, generally positive, wouldn't you say?
Yeah, I'd agree. They reiterated their full-year guidance, talked about momentum.
But with some caution, definitely. There's that big stellar blue integration happening, plus, challenges in Peru we need to talk about. Still, Q1 seemed like a decent start.
Okay, let's hit those Q1 numbers first. Quick snapshot. Revenue came in at $92 million.
Which is up 21% compared to Q1 last year, which was $76.1 million.
In that growth, mostly from their commercial and defense areas.
Yeah, though they did mention lower revenue from Peru, kind of offset some of that.
Right. What about profit? Adjusted EBITDA landed at $7.6 million.
Which is actually down from $9.3 million in Q1 24. And this is where, it gets interesting.
Stellar Blue, right?
Yeah.
The acquisition.
Exactly. Stellar Blue added about $25 million to that revenue number in Q1.
Okay, significant chunk.
But it also ran at an adjusted EBITDA loss, around $3.6 million for the quarter. They're still integrating, ramping things up.
And they made a point of this on the call, didn't they? If you take out that Stellar Blue loss.
Right. Look at the organic business, just Gilat pre-acquisition. That adjusted EBITDA was $11.2 million.
Which is up 20% year over year. So the core seems pretty healthy.
That's the takeaway there, yeah. Now, GAAP operating results. That was a loss, $2.7 million.
Big difference from Q1 last year, which was $5.4 million in GAAP operating income.
Yep. And the GAAP net loss was $6 million, or 10 cents a share. Last year, it was net income of $5 million, 9 cents a share diluted.
And the non-GAAP number?
Non-GAAP net income was $1.8 million. That works out to 3 cents per share diluted.
Again, down from Q1 24, which was $6 million or 11 cents per share.
So yeah, you can really see the impact of the acquisition costs and that initial Stellar Blue performance hitting those reported profit numbers.
Definitely. Like you said, the headline profit numbers look kind of mixed, maybe even down, but there's that acquisition noise.
Exactly. And the fact they're sticking with the full year guidance, that probably says more about their underlying confidence.
Okay, good overview. Let's unpack the segments now, get into the details behind those numbers and the key initiatives too.
Let's do it. Starting with commercial, that was the big growth driver, right?
Yes, $64.2 million in revenue for Q1 25. That's a huge jump, 56% from $41.2 million last year.
And like we said, $25 million of that was the Stellar Blue contribution.
So if you back that out, organic commercial was closer to $39 million, a bit down year over year.
Right. They mentioned pulling out of Russia last year had some impact there. But yeah, the headline story is Stellar Blue's immediate top line boost.
What else stood out in commercial?
A lot of talk about momentum, system deliveries, customer expansions, mostly driven by airlines needing better in-flight connectivity or IFC.
Next-gen IFC.
Exactly. They mentioned specific orders, about $15 million worth, for their SkyEdge IV platform and SSPAs.
SSPAs. Those are the advanced antennas, right, for LEO constellations.
You got it. High-performance ones for LEO, so it shows they're getting traction with these newer satellite types.
LEO and MEO.
Yeah.
Low and medium Earth orbit. Everyone's talking about them. So Gilat's starting to win business there.
Seems like it. It shows the market's moving towards multi-orbit, using LEO, MEO, GEO together, and Gilat's tech fits in. Okay, shifting gears. Defense.
Defense looked really strong. $23 million revenue?
Up 34% from $17.2 million in Q1 last year. Big increase.
What drove that?
Mostly higher deliveries, they said. U.S. and Asia customers primarily.
And they launched that dedicated Gilat defense division, too.
Yeah, and they highlighted a really positive market reaction to that. Management basically linked this straight to, well, everything going on geopolitically.
Makes sense. Defense budgets are up. Demand for secure Satcom is rising.
Absolutely. They mentioned specific demand from North America, Europe too, especially with sovereign network efforts picking up steam there, and Asia Pacific. Got multiple orders across the board, terminals, platform services.
Okay, so commercial boosted by acquisition, defense strong organically. Now, Peru. That was the weak spot.
Yeah, definitely the drag on revenue this quarter. Only $4.8 million.
Wow, that's way down from $17.7 million in Q1 last year. What happened?
Main reasons given were Delays. Delays in renewing projects, new bids getting pushed back, and just slower progress on network expansion.
So things just moving slower than expected.
Pretty much. And they also pointed out that Q1 24 included revenue from finishing up the construction phase of one project, the Amazonist expansion. That phase is done.
Ah, okay. So last year had revenue from a completed phase. This year has delays on starting new stuff or renewals.
That's the picture they painted. Seems like a timing thing, maybe project cycle issues.
Rather than lost business necessarily.
That's the implication, yeah. They stress the pipeline in Peru is still, quote, strong. And they mention making progress on like acceptance and handover steps for some existing networks, steps toward maybe future work or final sign-offs.
Got it. Okay, that covers the segments. Let's dig into those key initiatives now. Starting back with Stellar Blue, obviously crucial, $25 million revenue, but that $3.6 million EBITDA loss in Q1. What's the outlook?
Well, they stuck to their guns on the full-year outlook for Stellar Blue, still guiding for $120 million to $150 million in revenue.
And profitability. That loss needs to turn around.
Right. And they still expect to hit a 10% adjusted EBITDA margin run rate in the second half of 2025. So that Q1 loss, they see it as upfront costs. Ramping production, integration efforts, finding efficiencies before they hit scale.
So expecting significant improvement over the next few quarters. And how's the actual product doing? The Sidewinder terminal.
Sidewinder ISA. Yeah, that's their fancy electronically steered antenna for LEO and GEO. It sounds like it's getting real traction. Over 150 aircraft installed now. Yeah, and logged over 70,000 flight hours. They said customer feedback is outstanding. And a big win was getting it tested and certified by Panasonic.
That's huge in the IFC world. Any headwinds mentioned? Challenges?
They did flag one, a supply chain issue with a specific part, an LRU line replaceable unit.
Ah, bottleneck.
Sounds like it. But they're working on it. Developing their own internal replacement, actually, aiming to get deliveries accelerating again by, say, late Q2 or early Q3. And they're also working on cutting production costs for the terminal overall.
Makes sense. What about the earnout tied to the acquisition? Sometimes those get complicated.
Yeah, they gave some clarity there. The technical agreement with Boeing, the one about getting Sidewinder offered as an option on new planes, that agreement itself doesn't trigger the earnout.
Okay, so what does?
Future orders where Sidewinder is actually integrated during production, those could trigger payments. As for how it's tracking now, well, based on current delivery timings and costs, the first earnout milestone isn't on track right now. But the second earnout milestone, that is currently tracking based on their order forecasts. So kind of a mixed bag on the earnouts for now.
Interesting. But that whole Boeing OEM effort sounds strategically vital long-term. What else is cooking in R&D? New products.
Definitely investing there, especially for government and defense. That increased spending for Gilat defense, it's already led to new launches. There's a GLT modem, an Aquarius Pro DS modem, and a new 2.6-meter terminal for GILT data pass.
And these are built for the new satellite era, multi-orbit.
Exactly.
Yeah.
GEO, MEO, LEO. They're optimistic these will get picked up for government uses. And they're also working on a next-gen LEO terminal just for business aviation. ESR 2030, they called it.
Business jets.
Yep. Successful flight tests done, apparently. They expect a production-ready antenna by the end of this year, 2025.
So Sidewinder isn't just commercial airlines then?
No, they're looking broader. Mentioned expanding Sidewinder applications to like ISR intelligence, surveillance, reconnaissance, military defense uses, even VVIP aircraft.
VVIP, very, very important person jets.
You got it. And that Boeing OEM offerability plan, it's moving through qualification. They expect it to be available as a factory option early 2026. All this just strengthens their overall position in aviation connectivity.
Okay, that's the terminals. What about the ground segment? The gear on Earth talking to the satellites.
Demand's up there too. For SkyEdge IV and SkyTC platforms, again, IFC growth is helping drive that.
Anything new technologically?
Yeah, this was interesting. They're developing virtualization capabilities for SkyEdge IV. Think cloud-based, software-driven ground systems.
Making the ground gear more flexible.
Exactly. More scalable. Positions them better for these new software-defined satellites that are coming online. Keeps them relevant as the tech evolves.
Good point. And one last thing on initiatives leveraging Peru experience elsewhere.
Right. Digital inclusion, bringing internet to underserved places. They see global demand picking up, and they think the know-how they gained in Peru can be applied worldwide. Mentioned having opportunities in the pipeline there.
Okay, interesting potential angle. Let's quickly hit some other financial details. Margins were down.
Yeah, both GAAP and non-GAAP gross margins dipped compared to last year. GAAP down to about 31%, non-GAAP around 32%.
And the reasons.
Pretty much what we've discussed. Lower margins from Stellar Blue as it ramps, that amortization of intangibles from the acquisition, things like backlog value, tech value being expensed over time, and lower margins in Peru due to the slowdown there.
And operating expenses, OPEX, that was up too?
Yep, both GAAP and non-GAAP OPEX increased. Again, mostly consolidating Stellar Blue's costs, more amortization of those acquired intangibles, and transaction costs from the deal itself.
Okay, balance sheet check. Cash position went down significantly.
It did. They drew down $60 million from a new $100 million credit line for the acquisition. Ended Q1 with about $64 million in cash. Net of loans, that's roughly $4 million.
Down from over $118 million at year-end 2024.
Right. But that drop is mostly the acquisition financing. Plus, they used about $6.6 million in cash from operations in Q1, mainly for Stellar Blue's initial working capital and other acquisition costs.
So the cash use makes sense in the context of the deal. Anything else on the balance sheet? DSO?
Excuse, yeah. Day sales, outstanding. Excluding Peru construction revenue, it ticked up slightly to 75 days from 71. So customers taking maybe a tiny bit longer to pay. Shareholder equity dipped a little too, $300 million versus $304 million. A lot of Q1 balance sheet movement is just that acquisition accounting, working through consolidating assets, liabilities, goodwill, intangibles, earn-out provisions.
Right, the accounting mechanics. But despite all these moving parts in Q1, they stuck by the full-year guidance.
Absolutely. Reiterated it. Revenue guidance, $415 million to $455 million. That's like 42% growth at the midpoint. Pretty substantial.
And adjusted EBITDA.
Between $47 million and $53 million. About 18% growth at the midpoint there.
And they sounded comfortable hitting those numbers.
They did, yeah. Pointed to a strong backlog, covers almost 80% of the revenue target already, and a healthy pipeline they expect to convert during the year.
Okay. And just quickly, any comments on broader macro trends, adjustments they're making?
Yeah, they touched on raw material sourcing, said they're proactively shifting some production away from high tariff countries, maybe towards lower tariff ones, and also boosting U.S. production.
Responding to trade uncertainty.
Seems like it. Global economics, tariffs. They're adjusting. Noted a good chunk of their U.S. defense work is already sourced and made domestically, which helps insulate them a bit.
And those defense tailwinds are still strong.
Definitely. They reiterated they're benefiting from higher defense spending globally linked to, the geopolitical situation. And they also see opportunity from just more satellite capacity going up, plus that faster adoption of multi-orbit LEO, MEO, GEO, where their portfolio, especially Sidewinder and the new modems, fits well.
Okay. So let's try to synthesize this for someone tracking Gilat or the Satcom space.
Yeah.
What are the main takeaways from this deep dive into the call?
Well, I think it really comes down to Gilat being in a major transition year, right? Dominated by integrating Stellar Blue. You've got strong revenue growth, sure, driven by that deal, and also solid organic performance in defense.
But balanced against the negatives.
Yeah, balanced against that expected short-term hit to profitability from getting Stellar Blue up to speed, and those specific project delays dragging down the Peru segment right now.
So management's message is basically, we know about these challenges, but we're managing them, and the full-year outlook is intact.
Pretty much, backed by that backlog and pipeline. And they're clearly trying to position themselves for the future with these next-gen products for IFC government multi-orbit stuff. It's a story of balancing current integration pain and legacy project issues with capturing these new strategic growth areas.
That sums it up well. Now, you know what time it is? Standard disclaimer. This is our summary of the earnings call. It is absolutely not financial advice.
Yeah.
But if we were just brainstorming some wild ideas.
Yes. This is not financial advice segment, pure speculation corner based only on what we heard on the call.
Okay, outrageous idea number one. A trade purely focused on Stellar Blue's margin turnaround, happening faster than guided. They're aiming for that 10% plus EBITDA run rate in H2 coming off a loss. What if they nail that internal LRU fix super quick? What if production scales faster, cost cuts bite harder than expected?
So you're betting H2 profitability could surprise to the upside. Maybe that 10% run rate happens sooner, or maybe it's even higher than 10% by year end. A bet on really slick execution.
Exactly. High risk, high reward execution bet.
Okay.
Okay, idea number two, more of a timing play.
Right.
Betting on a specific big domino falling sooner than expected. Management talked about Peru delays, but a strong pipeline. They talked about potential big SkyEdge IV, SSPA orders, maybe Iris Square, other LEO deals. These big projects can be lumpy.
So the trade is betting that one or two of these significant deals, whether it's resolving a Peru delay or landing a major new contract, happens earlier or bigger than the market currently expects.
Yeah, providing a sudden, maybe unexpected boost to a quarter's revenue and profit. It's a bet on pipeline conversion hitting just right, or maybe a specific delay resolving faster than anticipated.
Gotcha. Both definitely speculative, based purely on reading between the lines of the call commentary.
And say with me.
Not financial advice.
Okay, so wrapping up. Gilat's 2025 is off to a start with solid revenue growth, thanks mainly to Stellar Blue and a strong defense segment.
But profitability took a near-term hit from acquisition costs and those Peru delays. The core business, though, looks relatively healthy, and management is sticking to their full-year guidance, pointing to that strong backlog.
Key things to watch going forward definitely include how that Stellar Blue integration progresses, especially on the cost and margin side.
Yep, that and whether defense keeps up its momentum, and if they start converting more of those next-gen multi-orbit and ground segment opportunities.
It really puts the focus on balancing those short-term headwinds, integration costs, Peru timing against the potential longer-term payoff from Stellar Blue's tech, and the strong demand trends in their key markets.
Leaves you with something to think about, doesn't it? How those pieces fit together as you do your own homework.